Hello everyone. Today's session is regarding money and banking and the financial system. It's going to be a brief description of money and the financial system as we continue on with the discussion. Thank you for joining, and let's get started. Most of us use money for a lot of different things, whether it's to buy goods and services or essentially it's a daily necessity that most of us have and are accustomed to. So essentially, what money is any good that can be widely accepted for purposes of exchange and repayment of debt. And we're used to having fiat money, which is currency, paper money. But money elaborated from the barter system when we used to exchange goods and services for other goods. It used to be that oranges were traded for apples, apples for pears, meat for eggs, and so on. The barter system existed historically back in the days. And money began to evolve when goods and services started to be accepted as one single item. In this case, gold, silver coins, etc., essentially started to create what is modern day money. A widely accepted good that is used by the public for all purposes. Essentially became paper money that is backed by the US Treasury. Now, what are the basic characteristics of money? Well, it serves three basic functions. It has to serve as a medium of exchange, it has to have a unit of account, a unit of measurement, and it has to store value. A medium of exchange is anything that is generally accepted by everyone in exchange for goods and services in compensation for the product purchase. A unit of account is any common measure in which relative values are expressed. You need to have a basic function of money, $5, $10. You can actually assign units of accounts. And store value, it needs to hold some value over time, stability in terms of the functions of money. Over time, it needs to be stable enough. And there have been various types of money that we have used historically to exchange or buy goods and services. The barter economy transition, it evolved over time. The economy is always growing, it's always generating economic activity that grows over time. And within a barter economy, we see that there's a significant issue. And that issue consists of the double coincidence of wants. It means that other people need to really want what you're offering them in exchange for what they're willing to offer. And sometimes you find that that's difficult to achieve. You have to find someone that is willing to accept what you're willing to barter for, and vice versa. So in a barter economy, a trader must find another trader who at the same time is willing to trade what the first trader wants to trade, and vice versa. And that could be very difficult. It could take a lot of time, and it could be tedious, and sometimes it's difficult to quantify what someone is bartering for. So the double coincidence of wants is a big issue in a barter economy, and that was obsolete right away historically for a lot of time. That is gone. In some communities in the world are still, in some cases, under the barter system, remote areas. So at one time there was no money, and people used to barter for goods and services. And money essentially evolved over time in a market-oriented economy. Historically, there have been silver coins, gold coins, copper coins, a lot of different methods that money has been used for. And how do we got to this point where it's just paper currency, dollar currency in the case of the US and other economies, the Japanese yen, the Mexican peso, the European euro, etc., the Canadian dollar, that is now fiat money, paper money that is backed by the US Treasury and the US government. It's no longer hard, tangible money as it used to be, like gold. So from a barter economy to a money economy, there was a transition process in which the transition process, it takes some time. And in a barter economy, some goods are more rapidly accepted than others, and others may not be accepted at all. So the more people accept any one good, anything, they know that they can easily trade it again for other things, and the greater the relativity of usage, the more people become to use it, the more it comes into just accept one common item, and essentially that item becomes the early forms of money, which could be like silver coins, gold coins, copper coins, etc. So the early examples of money were, as mentioned, the silver coins, gold coins, And the how we evolved from the gold coins to um, paper notes, nowadays paper currency, is that it used to be that um, to trade gold, you had to carry the gold, bags of gold, and people used to steal them. So early people started to depositing those gold coins into the bank, and the bank will issue receipts, and those receipts serve as paper currency, as notes, gold notes. You can go and buy products with that note, and whoever holds that note can go and cash it out from the bank. It essentially started to evolve from there on into modern day currency. So the exchanges can take a long time with a barter economy, but exchanges with paper notes or paper currency takes less time, and they're highly efficient. It frees up transaction time to buy goods and services. People are used to using it, and it increases the availability of time for other usage and the resources to be used into something else. So a money economy essentially is much richer. It generates more transactions in buying and selling goods and services, and the amount of leisure that can be obtained increases over time. Also, the standards of living depends on the number of transactions and the quality of goods and services that a person consumes in the market. And with an increase in transactions and consumption of goods and services, the individual enjoys a greater economic well-being. The average person's standard of living is higher in a money-driven economy or paper currency-driven economy than in a barter economy. Essentially, the barter economy is less developed and it's not financially stable. Now, what is money and how is money defined? Well, the money supply is defined into different categories. Two frequently used definitions of the money supply are M1 and M2. Most people are just familiar with money as the actual paper dollars that you see. But M1, money definition 1, is the currency held outside of banks plus any checkable deposits. The currency held outside of banks is like what we used to hold $100 the bills, the currency that we have, any coins, plus checkable deposits when we make a deposit at the bank. And any form of traveler's check or any check that we use to write against our account. Currency, basic currency and basic paper money is considered part of M1. What we have now is Federal Reserve notes. If you look at your regular dollar, $5, $10, $100 bill, it says it's a Federal Reserve issued note, a Treasury note. It's issued by the Federal Reserve, which is the central bank of the United States. With technically, it should be backed by commodity such as gold, but it's no longer backed by the amount of gold. It's backed by the stability of the economy and the faith of the Federal Reserve and its board members. Now, checkable deposits are what all of us do. When we go to the bank, we deposit our money, our check, and we can withdraw or write checks against. And essentially, that's a form of money, a form of M1, category definition of 1. Checkable deposits consider money M1. M2, the money definition M2 is everything that's included in M1, checkable deposits, currency, coins, paper notes, plus saving deposits, including money market deposits, small denominated time deposits like certified deposits, for example, CDs, and any mutual market mutual funds. What are saving deposits? Saving deposits are any interest-bearing account at a local commercial bank, at a thrift institution, and normally you need to leave them for a certain time, and you cannot write checks or withdraw with a certain amount, or you may have a slight penalty fee. Time deposits are also interest-bearing deposits with a specified maturity date, meaning that you need to leave them for a specific time frame. You cannot cash them out within 6 months or a year, and the time deposits are subject to also penalties for early withdrawal if it's withdrawn before the maturity date. These are typically like certified deposit accounts or money market accounts that are typically specified, locked in for a certain period of time. But they pay really small interest rates, very small. I'm actually kind of critical on the financial system, how they pay very little, like 1 to 2%, if anything, on those saving deposits and time deposits, and they penalize you from withdrawing early. But then they turn it around and issue loans at 7, 8, 20, 15% interest rates to the consumers. Just food for thought. So what's M2? M2 are also consistent of money market deposit accounts, MMDAs, and it's a type of interest-bearing account at a regular bank or thrift institution or credit union that requires a minimum balance. Usually, that is required to start a money market deposit account, like $5,000, for example. And you have limitations as to whether or not you can withdraw a certain amount or you need to maintain a certain balance. A money market mutual fund, or just for short, a mutual fund, is also an interest-bearing account that typically a regular consumer can buy one and let it mature for a year, 2 years, 5 years, 10 years, etc. And you also have limitations as to whether or not to withdraw. Typically, to get a money market account or a money mutual fund, those are meant for long-term stability, to keep them there for a while so your money can grow. At a later date, you might need it in case of a rainy day. And there's other types of accounts that you can use, but these are the basic definitions of money M1 and M2. And investment banking, there's other different type of programs that you can invest your money in. What about credit cards? Where do they fit in? Credit cards are paper credit cards, plastic credit cards. It's an instrument, or in this case a card, that facilitates the holder of the card to obtain a loan, which in this case is a credit that is credited to you. And the shopper can spend it anywhere, but the shopper can repay it back with interest. So technically it's not money, it's a transfer of existing funds to an account that you can use at a penalty rate, which is interest rates. And most consumers have 15% interest rates or 21% interest rates on that credit card. If you really have good credit, like 10 to 12%. But this is where I'm critical. If you put your $10,000 in a saving time deposit account or money market deposit account, the bank will probably give you 3-4% tops, right? That's your return on your investment. And then they use those funds with thousands of other depositors' funds and lend it to the public, like in credit cards, and they charge them 20% interest rates. So to you, they're only giving you a small percentage, but to the other people, they're lending it at a higher rate and they're cashing in significantly, right? So that's why I would say I'm a little bit critical on that end. But nevertheless, the financial system facilitates the pooling of funds from savers to lenders and borrowers and so on. So it's highly efficient. So whoever wants to use a credit card can pay the interest rate for using it. So how did the early banking system start? Well, there was a fundamental group of individuals that actually got together to start the financial system in the United States. And it first started as what is called the fractional banking reserve system. And in the early establishments of banks, all banks were allowed to hold reserves, and meaning when depositors will go to the bank, the local bank, they will deposit an X amount of gold or an X amount of commodity, or in this modern time frame, deposits. The banks are required to keep certain amount of that deposits as reserves in case people go and withdraw that money at any given time. So all of the banks are allowed to receive deposits and essentially keep some of that as reserves. When some of those deposits are withdrawn, then it's withdrawn on the bank, and the bank has enough reserves. But what about the extra amount? What can they do? Do they keep 100% reserves? Not necessarily. They only keep certain amount. So it's what is called a fractional reserve. You only keep a fraction of your deposits. So in the early cases, we had the gold deposits, silver deposits, and in the early transaction time frame, when money was consistently of gold and other form of commodity, carrying it around was relatively difficult because it has some weight. Some people will steal it. You had the all-American movies of cowboys stealing the gold. Most individuals will be scared when you transfer the gold. It will get robbed. So they turn to their local goldsmiths, which is the early bankers, for help. Hey, we want to store our gold there, and you issue us a receipt. And they trust the goldsmith. They will give them a receipt, which is a note, and say you have this X amount of gold within us, and you can use this receipt as paper currency. And banks started to realize that the individuals that will store their gold will not always go back and withdraw all of the gold. They will have extra funds or excess reserves that they can use for something else. And essentially, that became what is called a fractional banking structure, where the goldsmiths issue receipts on the gold that they will receive as deposit, and the client will go and use those notes and buy something, and whoever has that gold receipt can come and get some of that gold. That receipts became to be known as paper notes or gold notes. That became to be widely accepted because they were credited to having a commodity behind it. So here is a gold receipt, or a gold bullion of X amount of dollars. You will write the amount of gold that it was worth, and they would take the receipt, and cash it out if they really want to. But transacting with gold was difficult at that time, especially when we had a lot. So the early bankers, in this case, the goldsmiths, began to lend some of that gold that they kept in their vault, or issuing extra notes to the public that needed funding, and they realized they could do so and earn interest on them, on those loans, without defaulting them early, as long as people would not go and redeem them all at the same time, the warehouse receipts. So the warehouse receipts became to be known as a represented amount of paper currency, and they started to issue a lot more receipts, given the amount of gold that they actually had on the deposit reserves, and that became to be known as the fractional banking system. So you have a pot of gold that was only 100 pounds, and then you had 1,000 receipts that may or may not reflect your amount of gold that you have. And they started issuing more and more and more and more. And at some point, it used to be that in the early times, when people panic, they will go and attempt to withdraw their deposits, and the bank wouldn't have it. So that was the run on the bank, because they started issuing way too many notes. Nowadays, that will be rarely a situation that you can run to the bank and actually the bank will run out of funds. Most people have a trust in the system that there would be some funds, but we have seen the banks can collapse. There were several bankers that came together and actually created the banking system in the United States. Wells Fargo, Morgan Stanley Chase, Goldman Sachs, and so on. The early bankers created the financial institution system that we have today. And the financial institution system that we have today consists of the Federal Reserve, which is the central bank of the United States, established in 1913 to maintain stability and security of the financial system, and also to facilitate commercial banks in order to have some form of credible lending practices and credible deposit and depository institutions. So the Federal Reserve System consists of 12 Federal Reserve banks in the United States. The Federal Reserve structure actually serves as the central bank of the United States. There's 12 banks, and each of those banks are in different regions, and is where the regular commercial banks go and all actually bank with their local Federal Reserve structure. It's actually a very financially driven structure. You have your local commercial banks, where we as the public go to our local bank, Bank of America, Bank of Wells Fargo, Chase. That's our commercial bank. The bank itself has to take their deposits to their local Federal Reserve Bank. And that local Federal Reserve Bank has to meet the obligations of all of the banks in the region. So the Federal Reserve banking system is a 100-year plus structure that serves as the United States Central Banking Authority. And it consists of 12 banks that each of them have a president, and each of them decide on the money supply and monetary base, interest rates, and many other factors in the financial system. And the banks themselves have to report to the Fed and deposit their funds that the commercial banks have on the Federal Reserve banking system. And if one of the small banks or a commercial bank collapses, the Federal Reserve could step in and help them out. So the Federal Reserve is a very important financial institution that helps facilitates the financial structure of the United States. The Fed's role is, of course, to maintain stability, the monetary base, regulate interest rates, and they also set the amount of reserves that banks need to have within their vault in order to maintain liquidity. And the reserves are any sum of bank deposits that banks need to have at the Fed, on their vault, on the Fed, for them to be, in this case, in good standing. For example, if a local bank has $40 million in deposits at the Federal Reserve and $10 million in vault cash, it has a total of 50 million reserves. With those 50 million reserves, they can leave it at the actual Fed for liquidity purposes, meaning good standing, or they can use any extra reserves and start lending at the local level. The Federal Reserve sets a required reserve ratio, meaning that banks are required to keep a percentage of each dollar that is deposited at their institutions. Those required reserve ratio, it's essentially set by the Fed. If there's 100 million deposits going into a local bank, that bank needs to keep a percentage, like 10%, on their vaults or at the Fed for immediate cash withdrawal. It's a percentage of the deposit. So that's essentially what we came to be known as the required reserves, the minimum dollar amount any bank must hold against its checkable deposits as mandated by the Fed. So it's the 10%, and that means a required reserve amount, $10 million out of the 100 million deposits. So what do they do with the extra 90 million? Those are considered excess reserves. So the excess reserves are any reserves held beyond the required amount, the difference between the total amount of reserves and the required reserves, and the bank can lend any extra reserves to the public, to investors, to businesses, to consumers, etc. As long as the bank meets the required reserves or the reserve requirement, the Fed keeps it in good standing. The Fed's regular rule is that they specify the amount that any bank needs to keep as reserves to back up their deposits. In this case, at any given time, any individual can go and withdraw their money, and they need to have required reserves to satisfy daily withdrawals. Any excess reserves above their regular holdings, they can do something else. They can lend it to other banks, they can lend it to investors, they can lend it to the public in the form of credit cards, auto loans, home loans, etc. Or they can keep them at the reserve vault just for liquidity. So there's the excess reserves, that are the extra reserves that you have available to do extra transactions, and you have the required reserve amount, the ones that you need to keep. And you'll be surprised if there's 100 million deposits, you have your reserve ratio 10%, so you only keep 10 million that are required. The extra 90 are excess reserves. You can do anything that is allowed financially with those extra 90 million. As long as you keep 10 million for the withdrawals, you can always lend the rest. You have to meet your reserve requirement amount. The Fed's rule on the specified amount that the bank must hold. So financial systems are, one of the most important factors that we have. It essentially facilitates the amount of investment, the amount of transactions that take place. So the financial system in the United States is essentially a means of getting people with extra funds, which is surplus of funds, considered to be the savers, together with people who lack funds or have a shortage of funds, and facilitate those transactions. So you have the savers that are the lenders, and you have the borrowers that are the ones that borrowing the money, and then they can pay them interest. You have savers and borrowers. And the financial intermediary, the financial institution, is the one that facilitates those funds. It pulls funds from the savers, and it facilitates those funds to those that need it. And if people want to save in the bank or want to deposit into the bank, the bank, you know, can keep those funds or can do a direct finance, which they can finance other projects with those funds, and you have the faith that your funds will be there in modern day banking. So direct finance in this case is a method of transferring money where the borrowers and lenders come together in a market setting such as the bond market. So the direct finance in this case, you're directly financing a financial transaction. The actual lender, if it's yourself, you meet with the borrower and you directly finance the transaction, the financial transaction. Indirect finance is where you have a financial institution financing the investment. So indirect finance is a little bit different. A method of transferring money whereby the funds are loaned and borrowed through a financial institution. So this is typically what most of us do. Indirectly, you save your money in the bank, and that money is used to finance a lot of other things. The financial intermediary is where all of us go for credit card loans, auto loans, mortgage loans, some business loans. So be happy if you're saving into the bank because you're indirectly helping someone else finance their project. So the financial intermediary is crucial. It's any institution that transfer funds from those who have excess funds or safe funds, and they're willing to deposit them and lend them to those who want to borrow them in the financial markets. By all means necessary, the financial institutions facilitate the flow of transactions willingly between savers and lenders. But keep in mind that there is a risk in the financial system. If the bank collapses, your funds may be gone. But with modern day banking, the FDIC, the Federal Deposit Insurance, covers any depositor's funds. If the bank collapses, your funds are, in this case, saved by an insurance company. Most financial intermediaries are required to have some form of insurance on some deposits. Not all, but some. Within the financial system, we have what is called asymmetric information, adverse selection, and moral hazard. And asymmetric information has occurred in different financial mechanisms, typically in trading, financial stocks, or in the financial markets. Asymmetric information is a situation in which any economic agent on one side of that transaction has information that the other economic agent on a different side of the spectrum does not have. And that could be good and bad at the same time. Asymmetric information is when you have incomplete information, or someone else knows more than you do, and they can benefit from that for making a transaction. You can relate this to inside trading. When someone knows something that the other people don't, and they make a move to capitalize on that transaction at the expense of someone else, which leads us to, for example, moral hazard. So asymmetric information exists in the financial system, and some individuals have been found guilty of having information that other people do not. Adverse selection is any phenomena that occurs when parties on one side of the market have information not known to others, and to other individuals, and it can have adverse effects on of any either member of the market. So when we're looking at adverse selection, it's very related to asymmetric information, slightly different though. So adverse selection, any person or any party on one side of the market may have information that is not known to the other people. On the other part of the market, it can affect the other individuals heavily. So this is adverse selection, is when something is adversely affecting you. Slightly different than asymmetric information. Asymmetric information is a little bit incomplete information. The other one is when someone has information and they don't want to share it to the others. And it's going to affect the parties on the other side of the market negatively. So when you might be familiar with certain situations that have occurred with asymmetric or adverse selection. And moral hazard, to some extent, the financial institutions do have a moral hazard issue. So essentially, it's when we engage in a transaction knowingly that it's going to affect um, society or the public at large, but someone is going to save and keep us from collapsing. So, in technical ways, it's a condition that exists when one party to a transaction changes his or her behavior in a way that is hidden from the public and is very costly to the public. But at the same time, someone is there to bail or save you out. And we have seen this in 2008, 2009, during the financial crisis. It's immoral behavior to say the least. Um, and the U.S. government bailed out the financial institutions from engaging in risky behavior that put at risk the well-being of the public. You can actually say that they were victim of all three: asymmetric information, adverse selection, and moral hazard during the 2008-2009 crisis. They engaged in risky behavior by engaging in loans that were risky, misrepresentation of financial instruments and portfolios. They had information that they didn't even understood, or the public didn't understood as much. And at the end of the day, the public was affected, and the banks were saved and bailed out by the U.S. government. Moral hazard is when someone's there to uh, keep you from falling, even though you know you're gonna commit suicide. Right? They know you're gonna commit suicide. So in this case, moral hazard, it happens when you engage in a risky transaction, knowing that it could be risky, but someone there is willing to help you out. Um, for the basic one-on-one transactions that we engaged on, since we're looking at the financial system entry-level analysis, to just underline the conditions of what the financial system consists on. Later on, we're going to elaborate in detail this information further. The financial system has a basic balance sheet. And a basic balance sheet is a record of information that has the assets of the bank, anything that is of value, like property, reserves, interest-bearing accounts, tangible items, capital plan equipment, any asset that is valuable to the firm. And it also has liabilities. The liabilities, anything that is owed to someone else. And a bank's traditional asset or business activity is turning their liabilities into assets. They're good at this. They're the best. So if we have thousands of deposits going into the bank owes us that deposit, but they're not gonna keep it as, oh, we owe you this fund. No, they're gonna be very, very clever. So we're gonna turn these deposits and make them into an asset by what? By issuing loans to the public. And if you for example, if any regular individual has their checking account and it's at zero, they charge you a fee for not having enough funds there. They're good at making anything as a deposit or liability an asset to them. From time to time, banks do become insolvent. And insolvency is when they lack liquidity, they lack the funds, and the liabilities, the amount of things that they owe, are greater than their assets. And insolvency is the last point of well-being for any bank. It's when you don't have enough cash or liquidity to satisfy your transactions, or your assets are a lot less than your total liabilities. We're going to elaborate the balance sheet in detail later on as to what goes in the balance sheet, what goes in the liability side, and essentially get into the habit of converting liabilities into assets, because the financial system is very good at doing this and they rarely collapse. And if they do, it has to do a major economic financial meltdown. Now, the bank capital or net worth, it's the difference between their assets minus their liabilities plus any property, plant, equipment that they own, which within the assets, essentially at the basic level. The insolvency factors when your liabilities are greater than your assets. Make sure to increase your assets as a regular individual and minimize your liabilities. We're good for this session.